Hello, my name is Daniel Medmani-Ziegler, and in today's video, I'm going to talk about the effects of stock market on the US economy. I am mainly focusing on stock trading and its effects on the US economy. This is an assignment for Managerial Finance 2, instructed by my professor, Dr. Corey Cole. So to begin with, a little overview. The stock market actually started around the 1400s, but the actual first modern one was around the 1600s in Amsterdam. Now there are commonly or most popular four popular stock markets or stock exchanges in the US. The first one is the New York Stock Exchange in New York City. The second one is in Philadelphia. The third one is in Boston. And the fourth one is again in New York City. And the estimation of stock market, the value is roughly between 90 to 97 trillion dollars. So we're talking about pretty heavy, large market. Now, the effects of the stock market trading on the economy, what's the problem? What did I wanted to find out? What's going on? So obviously I wanted to know whether the stock market benefit the economy. I wanted to know whether the stock market performance is linked with the economy and with economic growth. I wanted to know whether an investment in stocks is a safe activity. How can we know that an investment is good? What is good? What is a measure of a good investment? How can we invest carefully without causing the economy to deteriorate? So whether our behaviors or our actions can impact the economy, and if so, how? And lastly, since so many people trade stocks and other securities, it is important to find whether a relationship between the stock market and the US exists. And if it does, how such an activity affects the economy. We want the economy to be stable. We want the economy to be even predictable. We want to know that the economy is safe. So this research aims at finding the effects of the stock market, and again, mainly stock trading on the US economy using S&P 500 prices. Relationships and literature review. So according to literature review, there is a relationship between the stock market and the real estate market, a relationship between the stock market and economic growth. Also, the stock market can be associated with good or more positive GDP and industrial production index, IPI in short. So when stock prices go up, GDP and IPI go up. There is also a relationship between stock prices and unemployment, a negative relationship. So when the S&P 500 prices go up, unemployment goes down. Okay, so we understand that there are some relationship. It's good to our understanding, to our establishment of the topic. But what are the effects of stock trading on the economy? This is what we want to know. This is what we want to assess. So for this analysis, the structural framework, I used economic measures such as GDP, GNP, CPI, inflation, interest rate, and consumer spending. I also did correlation between all of those economic measures and the S&P 500 prices. And lastly, I ran regression analysis. I took data from these sources. All of them are official sources. And lastly, I used the internet as a last resort if I couldn't find anything else. So for the findings themselves. So again, at first, it's really important to establish a relationship between stock market using S&P 500 and those economic factors / measures / variables. This is the first step in assessing, in evaluating, in determining whether stock trading can affect the economy. So the first one, the S&P 500 and the GDP from 2011 to 2020, we can see that there is a strong relationship. R and R squared are 98 and 96% respectively. we can see on the graph that both lines have linearly increased over time in a nice, smooth way. So it does suggest a strong relationship between them. By the way, I divided GDP by 10 just for better graphing purposes, but GDP is in trillions. At the bottom, you can see the regression analysis formula. I know it looks like an enormous number, but I would like to invite you to use your calculator and try it out. It's a pretty accurate um, equation, and we can find GDP to great certainty using S&P 500 prices. So it can help us estimate what the GDP will be like based on the stock prices, if we can know what they would be like. So maybe it's good if we can understand how the economy would be like in terms of GDP, for instance, if we have information about stock prices. As for the GNP, a pretty similar relationship, except for one change in 2020. I didn't run regression analysis for GNP and S&P 500 just because GNP and GDP are pretty related or pretty similar, so I didn't want to have a redundancy here. As for the S&P 500 and the Fed interest rate, it's not an apparent clear relationship. Interest rates are usually controlled by the Fed. We can see in the blue line that the Fed wanted to put it to determine them as low as possible between 0.75 to 102%, and then it went up a little bit. But overall, we can see that the relationship is not really clear. Stock prices, behave one way and the Fed interest rate behaves another way. So it's not really clear whether a relationship exists here or not. As for consumer spending, there is a somewhat relationship. It's a semi-strong relationship. It's not a very strong one. We can see that R and R squared are 83 and 70% respectively. And also the regression analysis provide us with a somewhat accurate equation, but not a very accurate one, only because the relationship between S&P and consumer spending is not as strong as the relationship between the S&P and the GDP. But there is an explanation to this relationship. So over time, if people have more money to spend, and we are referring to the consumer spending going up and up and up, then it is reasonable to assume that some of their spendings will go towards stock, to trade stocks. And this is something that might explain why those two graphs pretty much go together to the same direction. So consumers spend more after they have some of their portion saved, the other portion is being spent. And there is a good chance that they invest in stocks. And this is why partially the stock prices and the consumer spending can share a similar relationship. As for the S&P 500 and unemployment, we can see a nice negative relationship between them. R and R squared are 53 and 28% respectively, but it's a negative relationship, so it's okay. We can see that whenever stock prices go up, the unemployment rate goes down. And there is an explanation to it, or a suggestion is that when stock prices increase, the economy is supposedly more productive, it grows. And because of this, more people are employed. So it does reduce the unemployment rate as the economy grows, and the stock prices, S&P 500, can provide us with a indicator as to whether the economy grows. So it just goes hand in hand. Lastly, for the S&P 500 and inflation, we use CPI for inflation. There isn't a clear relationship between these two. We can see that stock prices go up. I divided the S&P by 1,000 just for better graphing purposes. And on the other hand, we can see that the CPI just fluctuate. It goes down, then there is a V shape, then it goes up and down again. It's not clear. It's not clear. We can only assume that over time inflation rate has decreased while stock prices have increased, but it's not clear what the relationship here is. It could be a semi-strong and negative one, but it's not really clear. Correlation. We can see nicely how the stock prices are correlated with other economic variables. A strong relationship between stock prices and GDP, and also a strong relationship between stock prices and GNP, and a strong relationship between the stock prices and consumer spending. There is a somewhat semi-strong negative relationship between unemployment and stock prices. We talked about it earlier. A somewhat negative relationship between stock prices and inflation rate, negative 0.252, and a semi-strong relationship between the stock prices and the Fed interest rate. Okay, so we ran all of those tests, all of those analyses. We plotted the information on a graph. We did correlation. Everything is nice and beautiful, but it's still not enough for us to show the effects of stock tradings on the US economy. So while some relationships exist, their magnitude is not 100% clear. Deriving something from them is not easy. Why is it not easy? Well, first of all, data provides a macro perspective view. We're talking about the aggregate, economic variables, and the S&P 500. Also, assessing the effects of stock market trading on the economy is extremely difficult. Why is that so? Well, it will require researchers to gather information about individuals, their investments, their return. It's a very micro analysis. What each and every one of us, people who invest in stock, what we do with our stocks, with our returns. Maybe we save our returns, our dividends, maybe we reinvest them. If we reinvest them in the company, maybe that company uses those dividends to keep growing, to keep producing, to keep becoming more productive, and thus it needs more employees, so it hires more workers, and thus the unemployment rate goes down. But there is so much if and so and if and so it's really difficult. Also, data collection might be very daunting and hard to obtain. Asking so many people about their returns, about their portfolios, is really unlikely to almost impossible to obtain. Also, future is uncertain. So maybe today an investment might be good. Many people invest in Apple, in Tesla, Microsoft, Facebook, so on, because they believe that those companies are good today, but we don't know what happens in the future. So how can we know whether an investment is good? How can we know what the effects of stock trading on the economy? We don't know. Lastly, research and literature review assert that a relationship between the stock market and the economy exists, and that this is a good positive one. So what do? We need to apply a macro perspective standpoint, the aggregate again, using an example, and then apply it to all. So let's suppose that Jeff Bezos, Bill Gates, and Warren Buffett, three of the richest men on earth, invest all of their money in the same stock. What is going to happen in the market? First of all, stock overvaluations. If all of them take all of their money, which we're talking about billions of dollars, and invest in that one stock, maybe it's not even a good company, maybe that company does not perform well, maybe its stock is very cheap, no one cares about that stock, there is a good chance that those people, those three gentlemen, will inflate the market. They will overvalue a stock unnecessarily, but this is obviously just for the purposes of this example. So we're talking about inflated market. We're also talking about interest rate fluctuations. Now, this point usually relates to bonds, but what it means is basically that, let's say someone buys bonds now at the moment, and let's say those bonds pay 10%. Let's say a year after, bonds pay 15%, maybe a year after 25%, maybe a day after those bonds uh, pay more and more and more because the market is just inflated. There is overvaluation. So at the same time, there would be interest rate fluctuation. It's not good. It's just too much in the economy in such a short time. Money is not allocated or not distributed evenly, not or maybe equally, not evenly, and it's just not good. And what happens when such a thing exists? So what happens is a bubble. We're talking about four bubbles: stock market, credit, and commodity bubbles. We are mostly interested uh, in the first two ones: stock market bubbles and market bubbles. There are five stages to bubbles, and I would like to begin actually with the last one, with panic. So only after a bubble has started, people actually start to realize, to understand that prices have been overvalued and disproportionate. So by this stage, there is panic. People are trying to sell their investments. They are trying to avoid huge losses. This is where the bubble's life cycle ends and prices are dropping back to normal. But what leads to all of those stages? So let's talk about the first stage, displacement. Excitement. People are really get extremely excited by a good, maybe a new news. Like I said, maybe Bill Gates, Warren Buffett, Jeff Bezos invest in something, so people want to do it too. They hear, they saw something maybe on the news online, so they want to join it. And this is the second stage, the boom. There is a surge, herding. People are waiting in lines, maybe nowadays electronic lines. They want to obtain investments or securities, stocks, whatever it may be. The third is euphoria. Prices are extremely high and overvalued, but at this stage, people are trying to justify their purchases. They think it's good, everything is okay, everyone else is doing it, nothing to be worried about. The fourth stage, profit taking, some people realize that a bubble is indeed happening. It doesn't smell good to them. They don't feel good about it. And maybe this is time to make profits as quickly as possible and exit the bubble before it pops. And then again, there is the panic. People might be late. They cannot sell their securities anymore. They may incur losses. And this is the last stage, the panic stage. So what do we do? First of all, we need to exercise caution when we invest in stocks. If we don't know what we do, how to do, we probably need to seek professional advice. Also, we can use, or we are advised to use, available technology. Nowadays, there is so many things out there. There are so many things out there, good technologies that can help us understand what to invest in, how to invest in, recommendations, see the trend, and so on. Basically, technology provides us with knowledge, and we know that knowledge is power. So we do need to use technology. We always need to read the news, see what's going on in the market, in the world. We need to realize that the future is uncertain. So just because a stock is worth a lot now and might be a good investment, doesn't mean that that stock is actually a good investment. We cannot just be dependent on something that we think is good at the moment. We need to utilize more tools, like I said, information, seek professional advice, and so on. And also, we need to be responsible. Be careful with your money. Your um, behavior affects other people. So even if you think that you're the only one who does one thing in the market and you're only one out of millions, there are so many people like you who think they are one out of millions. And the sum of them is millions that might do might make take bad decisions and deteriorate the market, the economy. And this is not good. So as I said earlier, we wanted to find the effects of stock trading on the US economy. We understood that it might be better to apply a macro perspective view and apply it to all, just because taking individuals and asking them about their portfolios, their returns, what they do with their money is pretty much impossible. But if we can look at the overview use, for instance, Jeff Bezos, Warren Buffett, and Bill Gates example, and then we can see what's going to happen, we can better understand what the effects of stock trading on the US economy are. We realize that those effects can cause the market to be overvalued, the stocks to be overvalued, the market to be inflated, and even to cause interest rate fluctuations. And all of that could also lead to bubbles, which are definitely not good for the economy. So if we really want to avoid all of those things, we understand that we need to exercise all of those things that I mentioned earlier, such as being cautious, use professional advice, read the news, use technology, and more. And this is all I have for today. I really hope you enjoyed this video and you learned something new. Thank you for watching, and I appreciate it. Bye-bye.